Why is it that India's brightest minds, engineers who can build rockets, designers of AI solutions, suddenly become ordinary when it comes to managing their own money? Are we one of them?
The reason most Indian employees don't invest isn't about intelligence. It's about inheritance. Not of money, but of mindset. This is a pan-India situation and is as much valid in Tier 1 as much it is in Tier 2 and Tier 3 cities. 71% keep money idle in savings banks account, 58% park it in fixed recurring deposits, and it has been studied that 95% prefer bank deposits versus even 10% returns that an equity or a mutual fund can give. 56% of our household financial assets are in bank deposits. 61% of Indians pointed out that they save the money and keep it in savings bank account to address emergency expenses. Between the age group of 22 and 45, from 6 metros and 18 plus tier 2 cities, taking data of 1,529 respondents, it was found that there is something deeply personal about how we save money in a country as diverse as India. Savings are not just about numbers on a balance sheet, but about dreams, security, and ambitions, where we are wrapped in a culture of traditions and organizing our finances based on how we have inherited certain information. Picture this: you are deep in a game, confident, focused, and then quietly, one crucial rule changes. You don't adapt, you keep playing as before, and that's when the game starts playing you. Before 1971, Bretton Woods system was in place. The Indian rupee was pegged to the US dollar. The US dollar itself was pegged to gold, which was $35 per ounce. This meant currencies were effectively backed by gold. In such an environment, holding money in bank savings, fixed deposits felt safe. Why? Because inflation was lower and more predictable. Currency had implicit gold backing. Money had hard value. Indian economy was closed with limited financial instruments anyway, so this was very meaningful. Now let us rewind. What happens after 1971? In 1971, President Nixon ended the dollar to gold convertibility, collapsing the Bretton Woods. Hence, rupee was no longer indirectly linked to gold. We have now entered a fiat system. Inflation, volatility increased in India, especially between 1970 and 1990. Holding idle savings became riskier. Currency purchasing power started eroding. Inflation often outpaced fixed deposit saving returns. Meanwhile, new investment avenues like equity markets, mutual funds, even though they began to emerge, was still novel for the Indian middle class. In 1971, Nixon promised it was just a pause. 5 decades later, the link between gold and dollar is gone forever. After 1971, our rupee lost its golden anchor. It wasn't tied to any commodity anymore. It is just paper which is printable at will. The moment gold backing was gone, the INR became pure fiat, unpegged and vulnerable to inflation. So, even when banks pay interest, many Indians end up losing. This conversation pertains to the risk and psychology domain of the financial flywheel through capital mastery. The rules changed in 1971, but our minds didn't. This isn't about intelligence, it's about psychology. Anchoring bias keeps us tied to the past. If saving works for our parents, then they must work for us too. Status quo bias makes the familiar feel safe. A savings account feels comforting even as inflation eats it alive. Social proof convinces us that if everyone's doing it, it must be right. Families, friends, colleagues, all reinforcing the same habit. And loss aversion, that is fear of losing money in markets, and that outweighs the joy of growing wealth. We'd rather accept 3% guaranteed than face volatility, ignoring the fact that inflation silently robs us of 7%. This is why we keep playing by yesterday's rules even when those rules guarantee failure today. This is not finance, it's psychology at play. And the truth is, even the most educated employees aren't immune. But is there a way out? Yes. It begins by learning and unconditioning financial biases. When we step out of the comfort zone of social proof and start asking the real questions in the domain of finance, that is how we stop being a saver and start becoming an investor.